Index funds, mutual funds, hedge funds, or ETFs. You've heard these names before. Today, I'll explain them in a super simple, practical way. Give me 10 minutes and I'll save you years of confusion. Quick reminder, this is educational, not financial advice. First, wait, what is a fund? Imagine you and friends organizing a party. Instead of one person footing the bill, everyone chips in. Together, you can get food, music, and decorations. A fund works the same way, but with money invested in assets. People pool cash, a manager or system invests it, and everyone shares the results. Let's start with index funds. An index fund simply copies an index, a predefined list of companies. Think of an index like a market scoreboard. The S&P 500 is a common example. It tracks 500 large U.S. companies. Index funds don't try to pick winners. They follow the index automatically. That's called passive management. Passive means very low fees, often around 0.02% to 0.20% per year. So on $1,000, you might pay just a few cents to a couple of dollars annually. Index funds spread your money across many companies, lowering company-specific risk. Important, most index mutual funds are priced once per day at net asset value after market close. That means your buy or sell order is executed at that end-of-day price, not instantly. Next, on mutual funds. Mutual funds often try to beat the market. They're usually actively managed by a person or a team. Managers pick which stocks or bonds to buy and when to sell. Active management aims to outperform a benchmark like the S&P 500. The trade-off is higher fees, commonly 0.5% to 1.5% or more. Higher fees eat into returns, so managers must outperform just to break even. Many mutual funds fail to beat index funds over the long term. Still, mutual funds can offer specialized strategies or sector exposure you might want. Like index funds, most mutual fund trades are processed at the end of the day. Now, hedge funds. Hedge funds are a different beast. They're private funds for wealthy or institutional investors. Hedge fund managers use advanced strategies, short selling, leverage, derivatives. These strategies can deliver big gains or big losses. Hedge funds charge high fees, the classic 2 and 20 model. That means approximately 2% management fee plus approximately 20% of profits. Because of the risks and fees, hedge funds are typically not for everyday investors. Finally, ETFs, or exchange-traded funds. ETFs are like index funds that trade like stocks. You can buy and sell an ETF anytime the market is open. That intraday trading gives you flexibility index mutual funds don't have. ETFs also offer diversification across many assets or sectors. Their fees are usually low, commonly from about 0.03% to 0.75% depending on the ETF. ETFs can track broad indexes, sectors, commodities, or be actively managed. Many brokerages offer commission-free ETFs, making them accessible for small investors. So how do these four compare? Index funds equals passive, very low cost, long-term friendly. ETFs equals low cost plus intraday trading flexibility. Mutual funds equals active management, higher fees, possible specialized access. Hedge funds equals private, high risk, high fee for accredited investors. Who should consider each? Beginners and long-term savers, index funds or ETFs. Want professional stock picking or niche exposure? Some mutual funds could fit. High net worth or institutional investors seeking aggressive strategies. Hedge funds. If you value trading flexibility and low cost, ETFs are attractive. A few practical tips. Always check the expense ratio before investing. Know whether a fund is actively or passively managed. Look at historical performance. But remember, past returns don't guarantee future results. Consider tax implications. ETFs can be more tax efficient in some markets. Think about how the fund fits into your overall plan and time horizon. Quick recap. Index funds and ETFs equals low cost, diversified, great for most people. Mutual funds equals active, possibly useful, but watch the fees. Hedge funds equals complex, risky, and expensive. Not for most investors. If you found this helpful, please like the video and subscribe. Share this with a friend who thinks investing is too complicated. I'll leave a video here that you'll probably like next. Thanks for watching. See you in the next one.